let's do it. Here we go.
First off, thanks everyone for showing up. Appreciate you guys, your interest in this opportunity at 4633 Southwest Huber. My brother and I are excited to get this one going. So, Chris, I'll let you take us off.
Okay. Well, I think we've got a couple participants in our last opportunity as well. So it's almost the exact same deal. So we're looking to raise 11 shares, $50,000. So that's $550,000, and it's a multifamily investment. So we'll kind of talk about, why we're the right guys to run this opportunity, and then we'll dive into the investment in a little bit more detail. So here we go. My brother AJ is currently a NARPM vice president, and he's got a master's in engineering management systems from Texas A&M, and also graduated University of Washington. He and I have built up our property management company. And we manage about 500 units now. We've grown a little bit this year, and we have our own investment portfolio, which we've grown. And the reason why we're doing syndications is that we are excited to share what we've learned in our experience with friends and friends of friends, so that we can dive into bigger properties and kind of focus in on generating large returns for people that we know. So yeah, go ahead, AJ. You can talk about me.
Yeah, Chris, he's certified property manager through IREM, which is a similar association to NARPM. Licensed broker in Oregon, investor. We both do contracting here. Successfully completed 1031 exchanges. He did the cost segregation actually on the last one. So him and I, we founded Uptown Properties, Uptown Construction, and then Uptown Properties also does brokerage as well. Graduated from U of A with business finance. Also had a full ride scholarship there. And if you see underneath his picture there, excellent golfer. Don't bet with him on the course. So.
Okay. Cool.
So yeah, I'm gonna talk about our last syndication that we did. So Chris got this under contract and just saw it was a great deal. We went ahead and wanted to do the syndication on it. We think that we were very successful with this. It was a purchase for $1.27 million. We raised about $400,000 in investor funds. We struggled with the financing at first. We went to a bank. They got us halfway there and then said, no, we can't do it. Before that, we tried agency debt, and there was just too many things wrong with the property. We ended up having to negotiate a more of a hard money loan. It was an 8% loan for a short amount of time, which we had to raise a little bit more money for, but because we're getting a really good property, we were able to do so. So we had the appraisal come in about a month and a half, 2 months ago at $1.8 million after we put about $70,000, $85,000 into the place. So the bottom pictures is what it looks like now. The two on the right is what it looked like before. So the picture of the kitchen is like a great example of the kind of work that we're able to do. So we're actually closing on that loan, I believe, the end of this week. And I think the proceeds from it should be about $1.15 million, which pays off the loan. And then we have to hold some reserves for COVID. And then we get the investors probably 10 to 20% of their money back right away. So that's pretty exciting in 7-8 months.
We can talk in detail a little bit more about Southwest 68th if there's any questions. at the end of the presentation.
Yep.
But this was a great deal for us on our first deal. So another great partnership that we've had is it's a portfolio that we started about 4 years ago with an individual investor who essentially provided us with a $1 million line of credit. And we've grown that portfolio to 33 units. And our most recent purchase in that portfolio was a 13-unit complex that we purchased for $1.35 million in Hillsboro, Oregon. And we've renovated 5 of those units, and it's 100% occupied, and it generates $13,000 of revenue per month. It's a similar idea to the syndication that we're doing right now, is that we're providing a 7% cash on cash, and the portfolio has grown to almost a $7 million value over the course of the 4 years, and we've gained about $1.2 million in equity, and we've left about $300,000 in the investments as capital investments. Current revenue is close to $40,000 a month, and cash flow on that is about $12,000 per month. And that's been one of our great successes that we've done in the past 4 years. All right, Paige is going to talk about the opportunity.
Yeah, so this opportunity, the address is 4633 Southwest Huber. If you guys look that up, it's right near where Capitol Highway meets Barber meets I-5. And one of the unique opportunities that we talk in here is 7 to 9 years down the road, the new Max line is going to be coming essentially right through there. In fact, what's projected, there's 4 different routes. On all 4 of those routes, this particular building is left standing, and many of the buildings around it either have property taken away from them or the buildings get demolished entirely. So some of the housing stock in that area will actually go down. But when that stock goes down, something else usually comes up, and it means that there's gentrification to the area, and more transportation makes it more desirable. In the other areas of Portland that we've seen Max lines come in, can't quote it exactly, but we typically see a 10 to 20, 25% increase in property values, not overnight, but very rapidly, at a much higher rate than we see other parts of the Portland metro area. So that's a pretty cool thing. Chris, you want to go to the next slide?
Okay.
You want to talk about value add?
Yeah. So the technique that we use on these syndications is the value add technique, and that is to find something that's undervalued and then implement a plan to have it operate at the highest level we can get it. So the value add plan that we've created for this property is that first of all, the current management is underperforming pretty significantly, so significantly that it's almost difficult to get a loan on the property. But the management company is struggling, so we're going to put in our tried and true management techniques and get leasing under control. And then as well, we're going to be upgrading units and pretty much doing a similar renovation plan as we did on the Southwest 68th property, which is going to be sprucing up the exterior and then doing a nice interior upgrade on any unrenovated units as they turn over. So go ahead, AJ.
Yeah, so purchase price is going to be $1.77 million, and we have about $27,000 in closing costs covered. Initial investment is actually going to be $600,000. So Chris, I don't think we're working off the same web file here. So, but it's actually going to be $600,000, 50 of which Chris and I are putting up. So The initial raise is $557,000. We have a preferred return of 7% cash on cash. I believe that this starts out at 6% over the first year as we get it up and going, 12 to 18 months, and then it should get up to 7 real quick. If you're not familiar with the preferred return, we will back pay future quarters, any quarter that doesn't make up to 7% before the syndication actually takes any sort of profits. On this particular project, we're looking at a 17% IRR hurdle. So after that 17% is hit for the investor, the syndication would split more on the profits afterwards upon a sale. And I believe that it's actually 1.1 million net sale proceeds after 5 years is what we looked at. I think we adjusted the cap rate a little bit after, and the pro forma after doing these slides. So, and then we have done a cost segregation on the last syndication, and we plan to do one on this one as well. And we typically return capital first, and then after that we start providing profit. So what this does is it allows for everyone to pay more taxes later as opposed to taxes now. So if for the money you get back, it's a return of capital. It's not necessarily profit right off the bat. So that shows up as a negative number on your K1s, and you can carry that loss forward. Next slide.
Okay, let's talk about the building and the unit mix. We've got 12 units, and they're 8 2-bedroom, 1 baths, and 3 1-bedroom apartments and 1 studio. And rents are currently $550 to $1,195. But we believe we can get the 2-bedroom, 1-bath unit rents up to $1,295, and then the studio and the 1-bedrooms to $995. So that's kind of our value add spread there. And then the benefit of the location is just to reiterate, the future Max line going in is going to change the area for the better. And that Southwest corridor there's going to be a new level of access and just a new level of density that is going to be experienced. And we really see that as a huge benefit. So that, along with our kind of high touch, high service property management and renovation, are the main value adds. Yeah. So AJ, do you want to touch a little more on the value add?
Yeah, so I think that on the pro forma, there's $35,000 in capital and $15,000 in operating costs, or funding the operating account over the course of 12 to 18 months. We have a bid for doing the parking lot, and we're going to look into doing that probably next summer or beginning of next summer. Getting the exterior painted, and there's some minor repairs just with some of the corner boards, and but it just needs a general paint job. So approximately 4 of the 12 units need to be updated, and as they come available, we plan on doing some of those updates, at least updating 2 of the 4 units, and we think we can do that within the budget, and then assess the other units as they come available and get them leased out. One of our main, the particular lender that we're going with right now, I think this is an outdated webinar, Chris, because the current lender that we're going with right now does not require 12 months of PITI, but after a certain amount of time, we're going to have to refinance, and if the COVID stipulations still are required by the agency lenders, they'll require 12 months of PITI, so that'll have to be dealt with upon that time. So, but one of the main things that we do is impose RUBS, rental utility billing system, and this increases income approximately 7 to 9% kind of right off the bat. So we believe that we'd be able to get that implemented in the first year for sure. So next slide.
AJ, do you want to pull up the pro forma and
Yeah,
I can share your screen. So here are some of the assumptions that we have made on our pro forma. 5% is what that's the one guaranteed number, is that we're going to be charging 5% for property management, 1% for asset management. And lender reserves will be $250 per year. But the income growth, that is an estimate over the course of over the past 50 years. Rent growth in the United States is kind of averaged around 5%. In Portland, we've seen a bit more rent growth than that, but in the past couple of years, it has been less than 3%. But we do expect, due to the new max, that income growth will be beyond 3%. Expense growth, 2%. That's just kind of a standard number. And then our cap rate on exit, this is something that we just add 0.5% to from the purchase. So I think on this version of the webinar, the actual purchase cap rate was 5.25. So to be conservative, we in making sure that we're not overestimating what our purchase or our sales price will be, we'll add 0.5% onto our exit cap rate. If anybody has any questions about that, about cap rates, let me know. I'm happy to explain. AJ, are you ready to share the pro forma?
Yeah. So yeah, I got the pro forma in front of us here. And so we've got $35,000 in the capital, $25,000 in the operating fund, and that's kind of where that $50,000 comes to do the value add. We've got all our closing costs in there and financing fees and all that sort of stuff. So we come down here. This is currently what it's at. We believe that we can shave some of that stuff off. Taxes definitely go up. Utilities, that's where we implement RUBS. And some of this other stuff, the contractor, landscaping shouldn't be that much. We do have a laundry facility that will take over. I think currently the units are rented. They had a hard time explaining to us how that works, but that's okay. And reduced property management services. Previous company was probably at more than 6%, but that's what they advertised. So coming down, we see kind of a 6% cash on cash return essentially. And that's that. So that preferred return will be short in the first year. This is conservative estimates at that additional 3%. We believe that we're going to be able to get this up probably a little bit quicker than that. And then as you see, years 3, 4, and 5, definitely above that 7% preferred return. And this is with the assumption of an LTV of 70% and 4.5% on the loan, 30 years. In talks with the lender, there's a possibility of going up above 70%. Have not seen anything yet on that. So, yeah.
Do you want to explain what the LTV does to, I guess, the total investment required and the returns?
So yeah, if the LTV goes up to 75%, that would change the amount of investor equity that we would need. So you can see that goes significantly down. And then it also changes the cash flow a little bit. And it would definitely change the internal rate of return. So just that there's more bank money in it, it juices it more because it's less than what the preferred return would be. So there's an arbitrage between the 7% and then the 4.5%. So with less investor money, there'd be more money for the investors that are in. So keeping that at 70% though, we see a 16.65% IRR for the investor. We're pretty confident that we can meet that. We believe that we have pretty conservative assumptions. Average rent increase on 2 bedrooms, we believe that there's a very high probability that 2 bedrooms become fairly sought after, especially in this neighborhood with the transit coming in, and annual operating expenses. Like we're pretty good at keeping our operating expenses down. So we feel like we're conservative in these numbers. Chris, did you want to talk about anything else on here?
No, I think you hit it all.
Okay. So, and I believe that the cap rate for sale on it, we had at 5.25.
Okay.
And that was because the rents were lower than what was advertised. So the cap rate on it is actually buying it at less because the net operating income is less. So.
Okay.
But, cool. You want to keep sharing your screen, or?
Yeah, I'll go back to. One second. Okay. So here is the current rent roll. Minimize this. But there is a little bit, there's some units turning over. So I think they've got 2 more units turning over, and then they've rented out these units 2 and 9. And then as well, unit 11, they've raised that person's rent. So this one is about a month old, and
it's been a fairly tumultuous with the existing property manager. Like we're kind of looking at it being like, what are they doing? So.
Yep. So that's the current rent roll, and let's look at some photos of kind of the existing conditions. They've renovated some units. You can see here that they've got some granite, and they've done some undermounts. They've done some top mounts. It's a decent level of renovation that they've done so far, but there are some units that are not renovated that we can work our magic on. So here's a photo of one where they just did the floor, but they left an old kitchen, and then they've got I think is that the same unit, AJ, with the old kitchen?
I think it is. That's one of the ones we got in on the inspection. So there was 3 units that we got only pictures of because no one wanted to let us in for
due to COVID.
Yeah. Chris, do you actually want to pull up the Rico tours? The 3D photos?
Let me do that. So here are some exterior photos of the property, and definitely sprucing up the exterior we feel like is going to make a big difference. So this is kind of a side view, and then this is the backyard. This used to be a swimming pool actually, but they filled it in, which is a very good idea. So that is the exterior. And then we've just got some more inspection photos here that we can scroll through. You can see some of the electrical panels are a little older. We'll plan on updating those as the units turn over. That was one of the things that we noted in the inspection. here is the laundry room, which we plan on renovating. And you can see the old pool equipment that this is a pump and a heater that we'll need to decommission and remove as we update the laundry room and create a good area for the water heaters. So yeah, here is a photo of an unrenovated kitchen that we'll be able to replace those cabinets, put in new appliances, and just get that rent. I think that rent is one of the ones that's around $800. We'll be able to increase that up to hopefully $1,295 for that 2-bedroom. So
yeah, and that's the other thing. I think we underwrote all of the rents to be $1,195, and we think that we can get them up to $1,295 very quickly. So when you look at the pro forma, like everything's at $1,195, and I think that they've got currently 1 or 2 of the renovated units are rented out at $1,195. So in our conservative approach, we're like, well, we know that they can get that no matter what. We're pretty confident that after we do some exterior upgrades, we'll be able to get some more.
Yeah. Okay. So do we want to open it up for questions, AJ? Or I guess we've got a little bit more of our track record in here. These are just some of the deals that we've done for ourselves. So we bought a 14 home purchase, did owner financing on it, and that's worked out to be a very awesome deal for us. And then we also just specialize in small multifamily. And so last December, we did the Southwest 68 syndication, and then as well in our 33 unit portfolio, we purchased a 13 unit property, and those have both turned out very, very well. So this is just kind of
some examples of our product and what we do. Typically dark floors, white cabinets, lighter granite, stainless steel appliances. So
yeah. Property management company.
We have a property manager.
That's kind of our main focus, is making sure that the properties are that revenue is as high as it possibly can be, and that we're keeping our tenant satisfaction and our lease renewal rates high. And yeah, anything else, AJ?
No, I think probably open it up for questions. Does anybody have any questions off the bat on this deal or past deals? And Michael, I think I muted you.
You did. Okay, I'm sorry. I was talking to my wife. Hey, so here's a question, and I get it. The rents are undervalued, and there's lots of room to increase those. But you're in Portland, you're in Multnomah County. We all know there's a cap of 9.9%. Unless you get them out, then do your renovations, then raise the price. What if you've got people who aren't going to go, they like their cheap rent, and they're not going to go anywhere? I mean, that's got to affect the game plan of raising those rents.
Yeah, and currently I'm in Oregon, and I know that some areas of the country are a lot worse than where we're at right now, at least here in Oregon. But our current portfolio, we're only seeing like 1 or 2% that aren't paying because of COVID-19. I'm assuming you're talking about COVID. Portland has the relocation assistance, which actually works out pretty good. We've been able to successfully negotiate cash for keys, typically less than what the relocation assistance is in those scenarios. And then if it really just comes down to it and they need to get out, we can pay that 2.5 or 3 times month's rent and get them out. Because this is under professional property management, a 10% increase over 2 years really gets us to our pro forma anyway. And if they're in, and we don't have to make any capital improvements to that particular unit, then that's great. So, I mean, we're looking at 4 to 5 units, 4 units that need to be renovated. So that's just 1/3 of the units. Like the other 1/3 are going to be at market rate already. So
Okay.
the chances of one of those 4 units coming available in the next couple years is, I think, going to be good with just regular good tenant, good property management, giving good notices, giving good increases, and staying diligent about it. So we've been able to
I
get-
actually wasn't talking about COVID. I was just talking about if you've got a unit that's way undervalued and you want to get somebody out, you're saying that it actually pays off to pay them off and give them cash for keys in the short and long run, right?
Yeah, I mean, in the short term, getting them out or coming to a deal and figuring out what to do. And
Okay.
honestly, when a tenant knows that they've got a good deal, like they kind of understand that it's coming, especially when a new buyer comes in. So
All right.
we've been able to negotiate fair terms for everyone in those scenarios, and it seems to work out just fine.
So Michael, as well, in every one of our leases, we write in the maximum rent increase.
Okay.
And so that when the tenant signs that lease, they're also signing the fact that they've received that rent increase. At absolute, we keep those timely at once a year. And generally, when we've got something under value, we do pretty well to get those tenants either up to market relatively quickly, but if it's severely undervalued,
right.
And I don't think that there was that one unit that was listed.
I think that one turned over.
But I want to say that that unit turned over.
Okay.
We don't have any like severely under, like more than 25 or 30% under on this particular deal.
Okay.
And if we can make 10% more per year, like that's going to be a great return. That would be way more than what we're showing in the pro forma.
Got it.
Yeah.
I'm going to stop the share.
Any
Dan,
other?
do you have any questions?
Hi guys, Ken here.
Chris.
Chris. So, what's your time frame on your window that's open to you with your financing? I've recently been working with some banks, and I see windows that are sliding around because of COVID. But, I mean, are they ready to go? What is your?
We are actively working with them right now to get ready to go. We've ordered the appraisal, so I'm just waiting to hear back and schedule that. So we've gotten to that point, so that's good. And we're confident. We've done one other deal with this particular loan officer before that we were skeptical on whether it would actually get done or not. So we know that he can get through the tough stuff and has seen our stuff before too. So that's always, working with someone new is always a fairly large hurdle as soon as they start seeing all the information come in. So we're very confident. We're very confident we're going to be able to get this done at what we've projected in the pro forma. And I will say that, like, we did hesitate putting the PPM out and doing this webinar until we were more confident with the lender. I'm sure, as you realize, like in this day and age with COVID and the lenders tightening restrictions, like it is tough. So we were cautious and hesitant to bring this out, and we are confident now that we're going to be able to get it done.
Yeah, there are too many underwriters out there that think that they read the headlines about 1/3 of Americans not paying their rent. They get a little skittish.
Yeah.
Oregon is a little different than the rest of America. So that's one thing that's working out on our side.
I guess the other question I had is how, and I didn't spend enough time studying your pro forma, but do you have some your capital items? I don't know what condition the roof is in, the water heaters in your units, some of the hidden capital assets. Where are those accounted for?
Are you talking about like capital reserves for those items?
Yeah, because you're starting reserves and yet what's the expectation? I mean, how many years are left on the roof?
The roof is in good condition. I think that it was installed in the past 10 years. But we do have lender reserves, which essentially act as capital reserves. So that's $250 per unit that's built into the pro forma. So it's around $3,000 per year.
Mm-hmm.
Yep. Does that answer your question?
Yeah, I mean, I just kind of want to know where it was because I also, you mentioned there's a special COVID reserve required. Is that's above and beyond your normal capital?
Yes. So
Okay.
that's 12 months of PITI. And
Right.
with this particular lender, they have not brought that up. I asked them specifically about it and they don't have anything. This is a local credit union that we're going through. If we do a refinance and go with agency debt with like Freddie Mac or Fannie Mae, those guys are requiring like 12 months of PITI as long as the governor still has mandated a moratorium.
Okay.
So, but presumably if we go for a refinance in 12 to 18 months, we would expect the value to be much higher. We wouldn't anticipate any sort of, we would anticipate a cash out in that scenario, even with having to fund 12 months of reserves.
That's very optimistic.
Well, I mean, we just did it over the last 6 months.
Right.
You know, our last syndication on 68th, we bought it for 1.27. It appraised at 1.8. We're returning 10 to 20% of the investors' money back in 6 months and funding that reserve account.
That's excellent.
Yeah.
Yeah.
Go ahead, Dan. Are you there, Dan? Oh. Okay. Cool. Any other questions?
Yeah, I've got a question. You mentioned the RUBS deal for the utilities. Are the units currently separately metered for all the water, gas, electric, et cetera, or how's that working at this point?
So RUBS stands for ratio utility billing, and Uptown Properties bills back based on square footage. They are separately metered for electric, but water, sewer, garbage will bill back on a ratio basis, and that's based on the unit square footage.
Gotcha. Okay, that makes sense. No plans to separately meter the water?
No, that would be a large capital investment that doesn't necessarily need to be done.
Gotcha.
And it would, if you do individually water or individually meter them, it's typically on a private side because the building development costs or the costs associated with the city are astronomical. It's not feasible.
Gotcha.
Dan, oh, sorry, Matt, go ahead.
Nope, that's good. That answered my question.
Cool. Dan, yeah, in the chat, he asked, what are our assumptions about refinancing? So AJ, what are, go ahead and take that one.
Yeah, I mean, at this point, we are getting the loan from the community credit union. It's probably going to be a 5-year, 30-year AM. So it would last the duration of this. We really feel like there's an opportunity to take advantage of the max line coming through, and current timing for that is 7 to 8 years out, kind of 2027, 2028. So maybe that's only 6 years out or something like that. So I think reevaluating in 12 to 18 months on whether a refinance is feasible is something that we'll take into account at that time. So I guess there is no assumption that it's definitely going to happen, and there's no assumption that it's not going to happen. I guess, is there specific assumptions that you're looking for? If we do a refinance, it would be with agency debt, non-recourse loan. We'd be going for that type of loan. Did
My
I?
mic turn on?
Yeah, I
Go
did.
ahead.
Oh, yeah. Sorry about that. No, I think that answers my question for now. Thank you.
Okay, thanks.
I guess the one difference between our previous syndication, Southwest 68, that 9 unit, is that we used a bridge loan to acquire the property. This is going to be more like a permanent loan from the community or the credit union that will be a little bit more permanent debt, or at least it'll act as permanent debt until we, I guess, reach that 5-year mark or the 3-year mark, when we're always going to be evaluating the investment to see when the right time to sell is. And I believe that when the max line, when they start making preparations for it, there will be other developers and other investors seeing what is happening, and then the desire for that property will go up. It's possible that somebody could buy up all of the land to put in a large development and buy us out with the intention of demolishing the building. But like, as I expect the area to change, and I don't know exactly what it's going to look like now, but I firmly believe that the property values are going to go up as the city of Portland invests, millions and millions of dollars in the area.
It's going to change for the better. And on another note of the pro forma, I know I talked about this already, but we do have other 2 bedrooms in the area that are going for $12.95 and even $13.95. So the $11.95 for the rents, and this kind of goes to your question, Michael, is that we're very confident that we're going to be able to get those up in a timely fashion. And with more people moving to the suburbs and kind of out of the city core, we're going to find that there's more demand for those type of units as well. And those being predominantly 2 bedrooms where people want a little bit more room. So another reason we think it's a good investment. Cool. Any other questions? All right.
Okay.
Well, thank you everyone for listening and following along. And as always, if you have any other questions, feel free to email us. We're happy to answer those and answer anything else. So
yeah, have a great Monday and have a great rest of your week.
Thanks for the update.
Yep. Thank you.
Thank you, Dan. All right.
Thanks, Ken.
Later.
Thank you. Bye-bye.